Howdy, Jacob here. Today we're looking at Gentex in the automobile components industry with 8.4 billion market cap, a little bit lower enterprise value, headquartered in Michigan, incorporated in 1974. Been around for a little bit here. Growth isn't crazy, 1.4 billion to 2.3 billion, but you don't need a whole lot of growth for it to be a fantastic investment. Return on invested capital high teens on average, it looks like. That looks great. Margins, ooh, that's the only thing. Gross margin declined 6% to 33%, and then operating margin from 29% to 21%. So that's not fantastic. About 240 million very liquid assets with no short-term and long-term liabilities. 299 total liabilities, so you're very safe on the balance sheet. Cash flow, okay, a bit of reinvestment, bit of acquisitions, a lot of share repurchases. They've historically bought back a lot of shares, and this dividend, from a payout perspective, is probably 25-30% on a 5-year average basis. Not too concerning. Looks like they're pretty consistent with that dividend. Um, yeah, okay, so let's start making some assumptions here. I would say that we're probably not looking at a fantastic growth for the business here. And especially since the last 2 years, they've kind of exploded because the car market was a little crazy. Maybe they dampened for a year or two or three, and then over a 7-year period, probably average, let's do 3%. And then let's do 16p and price to free cash flow, saying that at the end of 7 years, maybe they're not as inflated from a revenue standpoint. They're doing a better job being more consistent there. Margins here have been going down, so I will do a little bit lower than the average. Share change, they've been buying back some shares, but not as much recently, as they have been investing in themselves quite a bit in acquiring companies. See, I think that this is what I don't like. These acquisitions here from 2020 to now have really been decreasing that gross margin and operating margin, which is just kind of a bummer to see. Um, so maybe I'll bump this P down to 15, saying that maybe a little bit of the growth has come from acquisitions, which um, is fine, but my terminal P and price free cash flow are based on internal growth. And then for this dividend, let's just say let's say 3 let's do 2%. So this is saying that the use of cash is a 25% dividend, 25% share change, and then really a lot of reinvesting back in yourselves, maybe a little bit of acquisitions, since they don't have any short-term or long-term debt. So right now, just looks a tad expensive for me, but I hope you enjoy the video and have a fantastic rest of your day. Thank you.